Are major acquisitions and community partnerships the secret sauce to reshaping Canada's rental market? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy Mackay. Let's get right to it. This week, we're diving into some exciting developments for Canadian Apartment Properties Real Estate Investment Trust, or CAPREIT, which has been making waves with its latest strategic moves. According to Simply Wall Street, earlier this quarter, CAPREIT closed or agreed to acquire 5 rental apartment properties across Canada for a total of 214 million Canadian dollars. This includes a significant expansion into West Vancouver, a market known for its affluence and supply constraints, and an agreement to acquire a large, amenity-rich complex in Regina. On the flip side, CAPREIT also completed the sale of 2 non-core properties for 82.5 million Canadian dollars. Notably, it sold its land lease interest in North Vancouver to Inchkai Development Corporation, an initiative aimed at supporting Indigenous economic growth and strengthening community ties within the Canadian real estate landscape. The acquisitions in West Vancouver and Regina are particularly noteworthy. West Vancouver's market is one of the most affluent and supply-constrained in Canada, making it a strategic target for CAPREIT's focus on high-demand, low-capital expenditure properties. This aligns with their strategy to capture stronger rent growth, even as other revenue drivers might normalize in the coming quarters. However, it's not all smooth sailing. Simply Wall St. points out that elevated borrowing costs remain a significant challenge. The interest rates could impact the accretiveness of these new acquisitions, potentially weighing on future growth. Despite these hurdles, CAPREIT's long-term outlook remains optimistic, with expectations to reach 1.1 billion Canadian dollars in revenue and 793.4 million Canadian dollars in earnings by 2028, assuming a 2.2% annual revenue growth rate. For investors, the key takeaway is understanding that high demand in undersupplied Canadian rental markets continues to drive occupancy and rent growth. CAPREIT's latest moves in these prime markets support this narrative, offering a promising outlook for the future. As we keep a close eye on how these acquisitions play out, it's essential to consider the potential risks of rising interest rates and how they might affect CAPREIT's overall growth strategy. Now let's turn our attention to an exciting development from the Canada Mortgage and Housing Corporation, or CMHC. This is particularly relevant for those interested in financing home improvements or new construction projects. CMHC's Improvement Mortgage Loan Insurance has rolled out some flexible options that could be a game changer for homeowners and small rental property investors alike. The CMHC Improvement Mortgage Loan Insurance offers insured financing up to 95% of the as-improved value for 1 or 2 unit owner-occupied properties and up to 90% for 3 or 4 unit properties. This means that for those purchasing a home that requires some work or building one from the ground up, CMHC is providing an opportunity to finance these projects with lower down payments. Here's how it works. The insured financing is based on the lending value as determined by CMHC, which is the lower of the market value or the purchase price and cost of construction. This approach provides more financing choices for new construction and home improvements, making it easier for clients to finance their residential property purchases or enhancements. The program includes flexible advancing options for both small and large-scale improvements. For improvement costs less than 10% of the A's improved value, single advances are used. For costs greater than 10%, progress advances are available, with the CMHC validating up to 4 consecutive advances at no cost through their full service option. This can be a significant benefit for property owners looking to manage cash flow efficiently during renovations or construction. It's important to note that new construction financing must be approved by CMHC before the start of construction or at an early stage. The lender must maintain control of the entire building during the construction period, ensuring that CMHC-insured financing and any equity in the land are used to facilitate construction and completion of the project. This is a crucial step to safeguard the investment and ensure the project is completed as planned. For those considering this option, the maximum purchase price or as improved property value must be below 1.5 million Canadian dollars for homeowner loans and 1 million Canadian dollars for small rental loans. The property must be in Canada, suitable and available for full-time, year-round occupancy, and must have year-round access. This initiative by CMHC is a testament to their commitment to providing greater financing choices for Canadians looking to improve or construct their homes. Whether you're a homeowner or a small rental property investor, this product offers a way to enhance your property's value while managing your finances effectively. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.